All right, as we just agreed, maybe let me rephrase this. Let me rewrite this. I find it useful to write before doing anything. We just say that at the inception of the lease, we are dealing with the lessee accounting, right? Debit right of use assets with a certain amount, and then you have to credit the lease liability, liability with a certain amount again. Usually there's an amount that is common here, so it's no big deal. We just find it out soon. Okay, now we just decided to start with the lease liability, right? We started the lease liability. Now these are the way that we use to explain how to get this. Okay, so let us do this. Let us do this. Okay, so IFRS 16 states that the lease payments include the following. Oh, as I just told you, the common example, they usually use these fixed payments, but if you encounter anything else, no issue, just cope with it. Fixed payments, you are told that, oh, no problem, I'm giving you my machine. I'm the lessor and I'm telling you that I'm giving you my machine. Make sure to pay me $10,000 at the end of each year for 6 years. Those are the fixed payments. But also, there could be variable payments that depend on an index or rate initially valued using the index or rate at the lease commencement date. Now, this one is no issue because if you have something like this, it would be given in the question. They would give you the terms in the question and you would act accordingly. So in case they're giving you that, also record it. But now, when dealing the lease, there are some things. The lease can be terminated, maybe anything else. The lease can be extended, there is something like that. So you need to put all those things into consideration. For example, that's why they say an amount expected to be payable under residual value guarantees. You see this? Amounts to be expected to be payable under residual value guarantees. What are these residual value guarantees? You can tell someone can if someone can just say you can just someone can just tell you, or maybe you tell them something. You tell them like this. They say that, oh, you need to pay me $1,000 at the end of each year. Then they tell you that, oh no, that amount is too big. Let me pay you 7,000. In case I promise that after 4 years, maybe your asset will be in a better condition. Your asset will be in a condition that you can recoup 800. It's 800 actually. Then you agree, okay, no problem. In case that time arrives and I cannot get that, you need to compensate me for that. So that's what we call residual value guarantee. You guarantee the residual value. You tell someone, give me your machine. I guarantee you that after 4 years, this machine could be worth $700, 700, maybe $700 million. Could be worth that much amount. In case it is less than that, I would compensate for the difference. I would compensate for the deficit. That's what we call residual value guarantee. So if you're the lessee and if you agreed for that, you also have to consider that as a liability, right? As for the definition is given here, they say that a residual value guarantee is when the lessor is promised that the underlying asset at the end of the lease term will not be worth less than a specified amount. So you need to check. In the case it is less, then that becomes a liability to the lessee. They're just, you see, they're just normal issues. And then you have something here, options to purchase the assets that are reasonably certain to be exercised. You as the lessee, that property is not yours. It might be under your control for a certain period of time, but it's not yours. So if it's not yours, ultimately it could fall in the hands of the lessor. You have the option to purchase the asset. If you have the option that are reasonably certain to be exercised, to say that the option is reasonable, if you have an option is not necessarily exercisable. You may decide to exercise the option or not. You are told that, oh, at the end of 5 years, you can pay $1,000,000 to have this asset as your own. Then it's an option. You may just decide to exercise the option, or you may decide to leave the option to lapse. All right. So let's say that according to your definition, you just be trying to project what would be in 5 years' time because you are at the inception of the lease. So the lessor tells you that, oh, you can buy it for $1,000 million after 5 years. But if you just consider it, you find out that, oh, this asset in 5 years it would be less $3,000 million. So you say that, oh, it's better that I purchase it. I expect to purchase that asset because it's like I'll be gaining something. I'll be purchasing something of a very high value for a cheap amount. So I'll do that. So if you find out that it's probable that you will do that, you would also have to increase this option as part of liability, right? They're just normal concepts, very normal concepts. Although you're not necessarily having to observe them in an exam, but you should really know that there is something like this. Okay, another possibility. These are just possibilities. Termination penalties, right? You as the lessee, maybe you have entered into the lease, and after 3 years, you say that, oh, this asset is no longer useful to me, or maybe there is a better asset. There's an asset that is more superior. Let me have that and take back your assets. To terminate the lease. You have to check for the penalties. Of course, if you find out that, oh, maybe the penalties are just low compared to what I'm missing, compared to the revenue I'm missing from using a modern asset, let me just pay the penalties and actually acquire that modern asset, and I'll get much more. So if you find out that the lease term reflects the expectation that this will be incurred, you check at the lease term and you say that, oh, the lease term is 10 years, but I expect after 3 years, oh, I think I'm going to terminate this penalty, this lease. I'm going to terminate this. You also have to include it in the lease liability. So it's the issue of checking on whether it will be an issue in the future or not. That's why right now you might see that it can be an issue, but in the future it might not be the case. But no issue. That was your projection is at the stage of commencement. That's why you can change as time goes by, right? Okay, so let's just proceed. This lead at the beginning, you have to talk. If you don't talk when you just do explanation, you just do solving, it becomes not useful. So you have to talk at first. After this, I think it would be very easy. We'll just be going computations. Now, as I told you, when you speak of lease, you have to determine the present value because you are dealing with the lease at the commencement, but you are projecting 5 years, 6 years, 10 years later. So you really need to determine the equivalent of that amount of money in the future to now, to this time, this point in time. And that's why you need to apply the concept of time value of money, which would obviously include the discount rate, as I use 10% in that case. So the discount rate now, how do you obtain this discount rate? First of all, that discount rate should be the rate implicit in the lease. The lease is a contract or part of a contract. Now, within that contract, there should be a rate that is implicit that should be used for discounting purposes. Of course, even if it is not given, it can be obtained. If you just studied financial management, you would know something called internal rate of return, IRR. You can use that to obtain, but it is beyond the scope of this section here, financial reporting or advanced financial reporting. So it is usually given. Now, if this cannot be determined, now suppose the rate implicit in the lease cannot be determined, say then an entity should use its incremental borrowing rate. I hope you see this. What does it mean by the word incremental borrowing rate? What does it mean? Remember that if you say that there's a lease, lease is a financing, is a method of financing. You need something, you need a machine. Instead of going to borrow or maybe to use your money to purchase that, you lease. So it's a way of financing. So incremental borrowing rate means that the rate at which it could borrow funds to purchase a similar asset. Instead of going to the bank to purchase, maybe to take a loan maybe for a certain amount at a given rate and use those funds to go and purchase the assets, now I just decided to lease. So in case you cannot determine the rate implicit in the lease, you can use the incremental borrowing rate. You can ask yourself, from what bank am I able to go and secure the loan, and at which rate, so that I could be able to fund the purchase of a similar asset. So you can use that. But I think in an exam, it's just easy. You don't need to waste your time. It's obvious. Okay. Now we are speaking of the lease liability. Now we're just going to speak of the right of use asset. Right of use asset. Because we said debit right of use asset and the credit lease liability. Now this is easy. The right of use asset is initially recognized at cost. Just like when we speak of PPE 16 investment properties for the usually recognize them initially at cost. Now the issue is, what does that cost constitute? What does that cost constitute? First of all, the amount of the initial measurement of the lease liability. So it's easy. What you obtained from the lease liability above is just taken as it is and placed on the right of use asset. There are matters that we'll talk later, no problem about that. We'll see them later. Just take that amount, put it under the lease liability, and under the right of use asset, and it's over. Okay, there might be other things. For example, here we are told lease payments made at or before the commencement date. This one is also very, very, when you pay, when you are doing these payments, there are agreements that you pay at the beginning of the period and others at the end of the period. Now, if you pay something at the beginning of the period, that is no longer classified as a liability. So when determining this amount of the lease liability, you would not have counted that amount, but really you would already have paid. Now, just make a normal consideration. Just presume you're doing the double entry. You have paid something. Let's say you have paid $5 million. What would be the double entry? I would credit $5 million and then I will debit what? I will debit the right of use asset. That's why it seems that we say lease payments made at or before the commencement date. That means they are no longer a liability. So they would still come here to the right of use asset, but in a different category as opposed to that of the lease liability. I hope you got that. Yes. Also, all right, there are these things. These are things that are just normal. Initial direct costs. Even dealing with PPE, you can just, there are costs that are usually direct. Let's say, let me give you an example on the PPE. When speaking of direct costs, there can be a lot. Let's say that you have a direct cost. Maybe you have bought a machine from Japan. It's I'm just trying to take an example, but it's not relevant here. For PPE, property, plant, and equipment, you bought a machine from Japan, you need to pay for import duties, something like that. Of course, this is the lease, so you will be in the country. Maybe if you have leased out something from the country that is coming in, but that's usually not the case. So you would, after reaching the port, you would have to transport it maybe from there to your location. So you can say that's a part of initial direct cost in case you have to transport it, maybe something like that. You can do that. But usually, maybe any cost that is just involved in bringing that asset to its present location and the condition is usually classified as the initial direct cost. So it would be very obvious. But also, let's say it's a machine, you have taken it somewhere, you have gone there and maybe you have to fix it, or maybe it's a plant, you need to fix it somewhere. After fixing it somewhere, those are the initial direct costs. We say that ultimately that asset will be removed there. So we just project, we say, oh, after maybe 30 years or 25 years, I would need to go and remove that asset from there. Maybe I would pay $6 million in 30 years' time. Now we need the amount now. So you also need to discount that amount in 30 years' time to the current time, right? So that's why we say the estimated cost of removing or dismantling the underlying asset is per the conditions of the lease. So you just follow the explanations in case they need that. But for leases, this one is usually very rare. Maybe they can ask you something like this for a 16 property, plant, and equipment. But for lease, there are much more matters to explain. Maybe in reality, we might encounter that. So until now, I think we now know the content that should be included in the lease liability, but also in the right of use asset. When doing the question, it's very easy. It's just simple, but you need to know what is going on behind the scenes. All right. Now they're just describing the lease term. The lease term, I've told you, the lease term, you can have the primary period, and maybe there might be an extension, which we usually call the secondary period. So it really depends. For example, they say to calculate the initial value of the liability now in the right of use asset, the lessee must consider the length of the lease term. And IFRS 16 says the lease term comprises, there are these called non-cancelable periods, which are usually called the primary periods. But also we can have periods covered by an option to extend the lease if reasonably certain to be exercised, secondary periods, right? You have an option and you see that, oh, I'm going to exercise this option, so the lease period will be much longer. So it will depend on the question. But also they say periods covered by an option to terminate the lease if reasonably certain not to be exercised. Maybe you have an option to terminate the lease, but you find out that, oh, I'm not going to terminate. If you're not going to terminate, then it's obvious that you will cover that period, so it will also have to be counted. They're just normal matters, very normal. You just need to be aware that there can be something like that. Right. Okay, I just needed us to get at least one example. Don't worry, guys, we are just close. We're just close to completing. I just need us to at least one example. We see what has to be done. Okay. Test to understanding 3 is called, the question is called dynamic. Okay. The question says, first, the question requires calculate the initial carrying amount of the lease liability, which we just took a look on the contents, and the right of use asset. These are the first two things that we need to know right now. They just proceed and say provide double entries needed to record these amounts in Dynamics financial records. All right, no problem with that. That's just a normal issue. Let's just go to the question. The question says on 1st January 2021, Dynamic entered into a 2-year lease for a lorry. Okay, no issue. We are told it's a lease already. The already told us it's a lease, a 2-year lease. The contract contains an option to extend the lease term for a further year. Now, do you see? So primary period is 2 years, and then there's an option of 1 year. So to know on whether to consider it or not, just check whether this option is exercisable. From how you see it, would Dynamic agree to extend that one, or Dynamic will just deal with 2 years? You just read the question and decide. Dynamic believe that it is reasonably certain to exercise this option. Do you see this? So this shows that, oh, so even that 1 year option is exercisable. So I have to include it initially. Of course, later the decision might change, but as for now, no problem, just include it. All right, okay. Lorries have a useful life of 10 years. So lorries have a useful life of 10 years. Now, do you see something like this? If we are dealing with the books of the lessor instead of the books of the lessee, you would have, they are speaking of dynamic. Dynamic is the lessee. You have to read the question. That's what I usually seek to tell people in an exam. You need to read your question and know what you are asked. For example, they are speaking of dynamic. Dynamic is a lessee. If you are the lessee, you do not need to know on whether this is a finance lease or an operating lease, because in both cases, the same way is used, right? So always know what you are required to do from your question. Okay, so Loris, for example, here, if you had already gone about finance reason, or you'd say, oh, this asset has a useful life of 10 years, but maybe the lease is just for 3 years. You could ask yourself, 3 years, 10 years, oh, it's very obvious that Dynamic would have to return this role so that the owner makes further use to recoup the amount that is spent. But the question may give you another thing. Maybe the question may show you that, oh, don't just say that. Don't ignore these amounts of rent that are being paid in 3 years. They are capable of covering the whole cost. Oh, if they're capable of covering the whole cost, you could say, oh, maybe it's also finance lease, although there's an indication that it is not. Right. So as for now, just ignore that. You would find it later. Okay, further explanations now. Lease payments are $10,000 per year for the initial term of 2 years, right? And $15,000 per year for the option period. So yeah, at the end of year 1, $10,000, the end of year 2, $10,000, the end of year 3, $15,000. You already have your amounts. All payments are due at the end of the year. You also have to be very, very careful about this. If all payments are due at the end of the year, it means that the first 10,000 is at the end of the year. So you need to discount it 1 year. So you need to bring it back. The second 10,000 at the end of year 2, you need to bring it back by 2 years. And the third, that is 15,000, bring it back by 15 years. What if this question was saying that all payments are due at the beginning of the year? If it was at the beginning of the year, that means that the first 10,000 would be at the beginning of the year. So no need to discount it. It is already here. It is already at the beginning of year 1. It means now. Beginning of year 1 means now. But the other 10,000 would be at the beginning of year 2. You know, beginning of year 2 is the end of year 1. You have to learn that. That's why I spoke of financial management. If they're telling you the beginning of the certain year is the end of the previous year, right? Beginning of 2023 is the end of 2022. 2022 right now is ending. We are just getting into 2023. So if they tell you the beginning of the year, just try to take a look at the end of the previous year so that you know the number of years to discount, right? Okay, so they say to obtain the lease, Dynamic incurs initial direct cost of 3,000. So apart from these rent lease payments of 10,000, 10,000, and 15,000, Dynamic needs to pay the direct cost of 3,000. These are what we call direct costs, right? We don't know for what, but they just need to pay that. Just incur that, maybe to transport, maybe the assets to its working location and condition, maybe to install it. We don't know. Maybe they just paid the lesser. We don't know about that. All we know, there are direct costs. Okay, so they say that the lessor immediately reimburses 1,000 of these costs. Now, this question, the lessor reimburses $1,000 of these costs. Now, if Dynamic incurs 3,000, but the lessor reimburses 1,000, it's like Dynamic has incurred only 2,000, right? Yeah, this makes sense. So you could just say, oh, so initial direct costs were just like 2,000 because the lessor kind of offered support to the lessee who is Dynamic. And the last point here, the interest rate within the lease is not readily determinable. If the interest rate is not determinable, we use the incremental borrowing rate, which is 5%. So just like that, and we can proceed. Now we need to know the carrying amount of the lease liability and right of use asset initially. If you just get initially, subsequently they are very easy. Okay. So you need to know we had 10,000, 10,000 again, and then 15,000. But initially we paid the net of 2,000 because we paid 3,000, but we received back 1,000. Okay, that's test understanding number what? Number 3. Let's go there. Number 3. Test understanding. Yes, here. Now you have to take a look here. The lease is for 3 years. How? There is 2 years, that's the primary period, and then there is an extension of 1 year that is certain to be exercised, and so this gives us a total of 3 years. How do you obtain the lease liability? I just told, just take the present value of all the amounts that you expect to pay. So the lease of starting at 1st January, you have to know the date of starting. 1st January 20x1. Now, after 1 year, we just recorded the end of the year, right? At 31st December 20x1, we expect to pay 10,000 at the end of the year. At the end of the second year, 10,000, and at the end of third year, 15,000. Now, do you see this? These are what we expect to pay. So they are what constitute a liability. In case there are matters of residual value guarantee, something like that, maybe let me just extend this. Let's say the question said that, oh, Dynamic has promised that at the end of 3 years, this asset would not be worth less than $20,000, for example. But maybe at the end of that period, it is expected that the asset would be worth only $16,000. So we would mean that the residual value guarantee would be $4,000. That is $20,000 that has been promised, less $16,000, which is getting a shortfall of 4,000. So I would also have you written 4,000 here at the end of year 3, and I would also have to discount that. I'm just trying to put that matter into application, right? Okay, so how do you have the cash flows? All you need to do is just discounting, just applying the concept of time value of money. So these are not the issues. You do not need to follow the used. You can just do your own way. I just told you that you take the future value over 1 plus R power n. Now, future value, you can just say that the discount rate, there are several ways to obtain the discount rate. Maybe I just remind you, let me remind this. It's not a must do that. Discount factor, we call it discount factor. Discount factor is like this. You just say 1 over, then open brackets, you say 1 plus R, and then you say power, raised to the power of n, something like this. Or you can decide and write it this way. You can just say it's 1, then plus R, and then you say power minus n. You can just do this. You remove this one at the top, and here you put minus n. Now, what they did here, you see, they say 1 over 1 point plus 0 point over 1 over 1.05. That means they didn't use this second method. They used the first, and then they say R was 0.5%. So 5% is 0.05, right? So 1 plus 0.05, you obtain 1.05. So we would have here 1.05, something like this. Okay, so you start now. 10,000 was at the end of year 1. So to bring it back now, you have to bring it down by 1 year. That's why here we write 1. That's why 1.05 by 1 is 1.05. The next 10,000 was into after 2 years. So 2 years to now, you discount by 2 years. That's why they use 2 then. This 15,000 was after 3 years, so that's why they use 3 years. So you need to know why they did that. And you need to understand that they said at the end of the year. If they say at the beginning, if they say at the beginning of 20x2, that is at the end of 20x1. So 20x1 end to now is just 1 year. So you need to know the figures to apply here when determining the discount factor. Actually, this is wrong. This is wrong. They are wrong here. And they should not have written this. Discount rate is a rate, 5%, 6%. That's the discount rate. This is not the discount rate, it's the discount factor. I wrote DF here. I think that's a typing error. It's Kaplan, of course, but I think they made an error. It's a discount factor, not discount. Discount rate is 5%. Right. So you can, if you have a calculator, you can just get this in the calculator and multiply. 10,000 times 1 over 1.05, obtain this 95.24. Here, 97, here 12,958. If you add them up, you obtain that 1,552. This one should be the lease liability, right? Just like that. Should be the lease liability. So initially, so you'd have the lease liability, and you say that right now we already have the carrying amount of the lease liability initially, no problem. Now we need the carrying amount initially for the right of use asset. Now, as we said, as for the right of use asset, you just take the lease liability first as it is here. Initial lease liability, that is at 1,552, no issue. Then we said if there are any direct costs, we just have to include them. Anyway, direct costs were 3,000, but we are told that we are reimbursed with 1,000. So it's like we paid 2,000. So it was like that 1,000 plus 2,000, that gives us at the 3,552, right? Yeah, just like that. Let me, yes, this one is good. In case we need to use double entries, this one is something very essential. Let me tell you one thing. If you need to be proficient in these accounting subjects, you need to know how to write down the double entries. Double entries are everything. Not a lot of explanation in double entries, but they actually detail everything. Okay. For example, we said that you have to debit right of use asset and the credit lease liability. You already obtained lease liability at 1,552. All you need to do is you just shift this amount of lease liability to the right of use asset, right? So to the right of use asset, you add that 1,552 and lease liability, you have this one. Now you ask yourself, where did these other figures come? Direct cost. I paid 3,000, but I received back 1,000. So it's like I just paid 2,000, right? But actually, you can also deal with that specifically. I paid 3,000. If you pay something, you give out cash. If you give out cash, that means you credit cash. Just move with normal principles. So you credit cash for 3,000. Now, let me tell you one thing. When dealing with double entries, dealing with one side is very easy. Only the remaining side, you have to use logic, but usually it is not a problem. So you credit cash by that amount. Then, as we said, direct costs are usually capitalized on the right of use asset. So on the debit side, we go then and increase them to the right of use asset. That is 3,000. If you do this way, you would say that, oh, this is an asset. I debited 31,000. Then I debited 3,000. So I had a total of 34,552. Then remember, we are told that we are reimbursed with 1,000. So if you try to write down that double entry for 1,000, that means we were given back 1,000. So it's like we obtained cash of 1,000, just like this, right? And then actually, since remember that we had increased the 3,000 to the right of use asset, but actually we have received 1,000 back. So you can say, oh, so we made an error. We made an error increasing the right of use asset by 3,000 while we should have increased them by 2,000. So you reduce from right of use asset by 1,000. Or simply speaking, you can just deduct 3,000 minus 1,000, you have 2,000, and you just debit right of use asset by 2,000, and you credit cash by 2,000, and everything gets settled. So you could have done that. So this is what I wanted us to go through today, to know how to deal with the initial measurement. Subsequent measurement, subsequent measurement, that one is very easy. You can just find out actual, maybe actually you might find out that maybe you know how to deal with subsequent measurement. It's easy, right? Subsequent measure, we have about 7 minutes here, but it's not bad. You can just take a look here. Let's finish up with these minutes. Subsequent measurement. Now you have a liability. If you have a liability, you just amortize it like a normal bank loan. A normal bank, how do you deal with a normal bank loan? You would open with a certain amount. If there is an interest to be charged, they charge you interest. Maybe, if you are paying, it depends on whether you are paying at the beginning of the year or at the end of the year. If you are paying at the end of the year, that means the interest accrues first and then you pay at the end. So you have initial amount, initial liability, interest to be expense, and then amount paid at the end. The same. So that's what I need to go through. They are just written it this way in the form of double entries instead of in the form of the tabular form, but we'll use the tabular form and everything will be just fine. If you just take a look here, look, you have the liability. You would have the finance cost, which would increase the lease liability. Then at the end, you have to pay, right? You have to pay at the end of the year. So if you pay, you give out cash, you credit cash, and then the liability decreases, just like that. And as for the right of use asset, this one is easy. You may just decide to depreciate it as you wish. For example, let's say it's just a matter of decision. Let's say I've dealt with investment property. Let's say I've rented a house. If it's a house, uh, the way to obtain that cost of the house, since it's a lease, you have to follow the principles of the right of use asset. But after that, you may apply IAS 40, just as usual. So it really depends on the situation. Maybe if it's IAS 40, use cost model, fair value model. It really depends on the situation, right? That's why it really depends on the situation actually. So it might follow other classes of the assets. You just take a look, oh, this asset belongs to this class. This class is being treated this way under this model. Okay, let me follow that model. It's no issue. You can just follow that, right? So that's what I needed us to do. So tomorrow, we are just going to take a look at this subsequent measurement, go further with that question, and then move to what? We have to move to lesser accounting. Then after lesser accounting, we will finish with sale and the leaseback, and the standard will be over, right? Hello?